Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest. He's a former investment banker. He has a radio show, Turning Hard Times into Good Times. He has a gold, energy, and tech stock newsletter, and his newsletter has been around for 35 years. Jay Taylor, thank you for joining me.
My pleasure. Thanks for having me, Jason.
Now, Jay, I want to ask you about the Austrian School of Economics. How did you find it, and why do you like it?
You know, I think the Austrian School of Economics is just completely logical. And if people were not indoctrinated away from it through our educational system, I think most people would understand it, would sort of just naturally agree that Austrian economics, the school is really the school of the way things really are. It's only, I think, in the interest of certain people who control the banking system, who are behind the scenes, who stand to gain from our ignorance, who have indoctrinated us to believe that somehow a few people operating in a boardroom somewhere know how many pairs of shoes we should wear that are going to be in demand across the country, or what the interest rate should be, or how much money we need, or this or that. So instead of letting the markets decide these things, some people have sort of self-appointed, self-ordained themselves to be in charge of knowing things that only the collective wisdom of markets can know. So, Austrian economics. I mean, I would say that I am a believer in Austrian economics. I wouldn't say that I am a scholar of Austrian economics because I haven't really worked that hard at it. I haven't. I'm a part of a group of guys that talk about some very detailed issues in the markets these days. And I normally I have too much to do in the market to try to figure out if I can make money or not, than to get involved with academic issues. So I just think I started looking at the way the world really works, and it didn't seem to be the way the policymakers are suggesting it is working or should work, or the way the mainstream media is describing it as working. And I guess maybe the first time I really started thinking about it had to do with the monetary system. I was a long time ago, I was a sophomore in college at a little junior college out in Kansas, and I had a history professor that was absolutely convinced that nations that the work ethic of nations, as well as its overall morality, declines when you start debasing the currency. And so there was a whole issue of the Federal Reserve increasing the money supply, decreasing the money supply, and of course the bias has always been towards increasing the money supply. And so that was the debasing of the currency that Professor Yoder warned me about, and I started watching that in late 1960s. And of course, I remember very well, I'm old enough, Jason, you are not, to have lived when the gold standard was still a reality, at least the international gold standard. And that kept all the banks, the central banks from around the world, from increasing unlimited amounts of money. And but we had Vietnam and we had socialism, and somebody wanted both of those things. A lot of people wanted socialism. Some people wanted war. It had to be paid for, but the politicians, Nixon and Johnson, didn't want to come and tell us that we were going to have to be taxed to pay for it. So they started issuing debt and printing money to pay for the debt. Charles de Gaulle, quite wisely, said, we want the real thing. We want to take advantage of the Bretton Woods arrangement, and we want you to send us back lots and lots of gold for the dollars that we're holding here. And so we saw a run on the gold, on the supply of gold in the Treasury. And Nixon said, unilaterally caused the United States to default. We decided we weren't going to pay back the gold. We weren't going to pay France or anyone else gold. And Nixon just slammed the gold window shut. The United States could do that and get away with it because of our victory in World War II. And we were the primary world superpower. At least in the so-called free world. And so we started really going off the rail. And I think, of course, long before that, the idea of Austrian economics, at least in the monetary system, had run off the rails a long time ago. Milton Friedman was a good Austrian if you excluded the monetary system. All of his views of free markets were, I think, spot on. But when it came to the monetary system, somehow he thought that the government should be involved in controlling the amount of money or the central bank should be in control of the amount of money that's created. I mean, that never quite washed with me, because how could it be that, one half of every transaction would be a manipulated part of that transaction then, because the price of money would be distorted. So I've read, of course, read the great, to a certain extent, I've read the great Austrian thinkers. I think, Jason, the short answer to your question is that I've become an Austrian and a believer in Austrian economics, because if you observe how the real world works, it most closely describes it.
Yeah, the track record for these PhD Keynesian economists and monetarists is not very good. Go back and look at past Federal Reserve predictions. Whether it's tough to know whether or not they actually believe some of their predictions, or if they were outright lying to the markets, like what Ben Bernanke was saying about the housing market in 2007, how there was, subprime was contained. It's tough to know whether or not he actually believed that, or if he was lying.
Yeah, I think maybe Bernanke did, but I think if you go to Alan Greenspan, I think there it's quite clear that he didn't believe a lot of the things he was saying. And very interestingly, I had Ron Paul on my pre-recorded Ron Paul for my show next week, and Ron had a lot of interesting uh, interactions with Alan Greenspan, and Greenspan understood all the way through, when he was chairman of the Fed, that he was destroying the country and the currency by creating money, and it's clear that he still believes that. And interesting exchange the other day when he was on Bloomberg with Tom Keene, talking about how we probably should go back to the gold standard, and reminded Tom Keene, I don't think he wanted to hear it, that in fact the most the best time progressively in terms of economic progress that we had was 1870 to 1913, when we were on a pure gold standard. So he understood very well that what he was doing. Interestingly enough, Ron Paul told me this years ago. In fact, he sent me a copy of an autograph from Alan Greenspan. Greenspan was after one of the House Banking Committee discussions with Chairman Greenspan, and Ron Paul took a copy of an article that Greenspan wrote back in 1966 called "Gold and Economic Freedom." It appeared in Ayn Rand's newsletter, The Objectivist. And Ron asked Alan Greenspan. He said, "If I just he said, I read this letter, read the article that you wrote years ago. Would you still agree with that?" And Alan Greenspan said, and this was in 2002, Alan Greenspan said, "Yes, I recently read it and I would not change a word." Now in there, he basically acknowledged that the Federal Reserve, that creating money was destroying the currency, was destroying the country, was really not allowing free market economics to work. So, it's very clear in my mind that Alan Greenspan knew what he was doing. Ben Bernanke might have drank the Kool-Aid that he was given through his PhD program, through the Ivy League schools that he attended.
Yeah, I consider Alan Greenspan and Benedict Arnold, a sellout. He knew better. I mean, he had studied under Ayn Rand.
Yep.
Obviously, he was a panderer to power. I think he cared more importantly, what others felt about him. The high, powerful bankers on Wall Street and the powerful politicians in D.C. and things like that. He cared more about what they thought about him than about doing the right thing.
Yeah, it certainly is true. And don't forget, he was knighted by the Queen.
Oh, I actually didn't know that. I didn't know he's Sir Alan Greenspan.
Yes, he is. Yeah.
I don't think I've ever heard anyone call him Sir Alan in a
Well, they
while.
don't seem to call him that, but I think if you Google it, you'll find it's true. Unless I'm completely forgetting, and unless I made that up in my own mind. But no, I think that was true after he left the Fed, or maybe before he left the Fed. When things were going really well, he was given a great deal of credit. I can go back and remember 1987. I remember it very, very vividly, and he talked about it the other day, in fact, on his interview with Tom Keene. 1987, the stock market crashed when the Dow went down some 23%, I believe it was, that very day. I mean, it looked like the world was coming to an end, and there were no takers for the best companies in America for a while. But that's when they started the Plunge Protection Team, or the President's Working Group, I think it's called. And that's when I believe they started to manipulate markets. And so and they created circuit breakers and that sort of thing. So whenever the markets would start to really implode, they would do whatever it took to use Draghi's words, to change things and to keep the market from falling further. So, that worked for a while, and all the Keynesian stuff, the stimulus works for a while until I believe there's some level of debt uh, in which you cannot any longer get any benefits from creating more debt money, because don't forget, we have fiat money is really manufactured by debt. Debt is the raw material from which money is created in a fiat currency system. In a gold-backed system, or an asset-based system with gold or silver, whatever it is, you have a real substance that creates an intrinsic value for the money. But all we have is a negative value for money now. It's called debt, and you can do that for a while. But once the debt starts to become so onerous, then it weighs you down, and there's no growth to be had. You've reached that peak in which you cannot stimulate any more growth, and I think that's where the global economy is right now. It's very, very worrisome, I think.
Yeah, I completely agree. And we see that with the stress of the banks who have given out bad loans and the stress tests now with the news stories. The Federal Reserve, I think, just announced today that whatever their stress tests are, and I think they're probably pretty low barred, they announced that Deutsche Bank and Banco Santander, who is in Spain but has branches all over South America and Latin America, and they have exposure, to base metal miners, copper miners in Chile, and consumers in Latin America who are tied to exporting to China. Those guys are hurting.
Yeah.
So I think. Excuse me?
Yeah, no, I completely agree.
Yeah, I mean, the debt problem, one of the things is Keynes believed so much in banks lending and debt, and he believed in the Keynesian multiplier. I mean, these things are fallacies that maybe when the US was generating so much productivity and there was savings and things like that, they could take on a little bit of debt and get some positive growth there from a little bit of debt. But the thing is, you have to have cash flow to sustain the debt, and we just haven't had that in the real economy for a long time.
Yeah, and Jason, one of the concepts, the Austrian concepts, is malinvestment. So when you start creating endless amounts of money, you start to see capital flowing in areas that it would not flow if you didn't distort the price mechanism, or if you allowed allowed price discovery of capital, which is what they're completely disallowing now, you would have efficient allocation of capital, to put it another way. So you can remember very well the 2000 and what happened with the dot-com bubble, and then of course the housing bubble, and now I think the biggest bubble of all, the sovereign debt bubble globally, which I think is maybe we're running towards the end of that.
Yeah, there's so many bubbles out there, Jay. I mean, it's hard to keep track of all of them. I was watching a documentary about the housing bubble in Vancouver, how Chinese, kids of crony capitalists and kids of Chinese Communist Party members are buying homes in Vancouver that used to be only a couple $100,000 15 years ago. They're paying $2 million, $3 million cash for them and not even using them anymore. So there's entire, neighborhoods of houses that have been paid for with millions of dollars in cash that no one lives in.
Yeah, it is absolutely true. And then think of the waste. If you talk about the lack of productivity, if capital is flowing into areas that are not, if you're not allowing price discovery of capital, then it goes into areas where there's no productivity, where there's nothing to service the debt with. So debt is growing exponentially, and income, if it's growing at all, and I doubt that it is in real terms in the United States, for example, then you don't have the wherewithal to repay the capital. But worse than that, you're not growing the economy because capital is not flowing into productive areas.
Exactly. And I've listened to a lot of the archives in your radio shows over the years. And one thing I love what you talk about in the past is that the real value in the economy is not created by the bankers, trading pieces of paper back and forth, traders and hedge fund managers and investment bankers, doing fancy trades and leverage carry trades and things like that. It's in the real economy, the miners, manufacturers, farmers, entrepreneurs, and inventors who are creating things. Finance is supposed to help these companies grow and create real jobs. And it's not really doing that. Instead, these hotshot guys on Wall Street and in different areas like London have just decided that, we don't need the real economy. Screw them. We can borrow almost at zero from all these different central banks, whether it's Japan, London, the United States, you name it, and just trade pieces of paper back and forth, get rich for ourselves, and while the real economy gets worse.
Absolutely. And let's not forget also that I mean, one of the reasons that Nixon took us off the gold standard in 1971, as I mentioned earlier, was because somebody wanted to have Vietnam. And so, what it also allows for, by having these very low interest rates, it allows our government to continue its war machinery. It allows the empire to continue to expand and undermine and change governments and do all manner of things that really create us, I think, make us less safe. You know, Ron Paul said when he was running for president, the reason they came over here is because we're over there. And I talked to Ron this past weekend. He reminded me that the United States is starting to surround Russia now. Well, what would we feel if Russia put their troops on our borders in Mexico? So the point is that we're making this a less safe world economically and I think geopolitically by this cheap money. It's allowing us to do all manner of things. I mean, the Congress doesn't have any say anymore. It doesn't have to worry about where the money's coming from. The Fed just prints it. Once, when we had an honest monetary system, it was much more difficult for a president to just unilaterally declare war or start a war. It was more difficult for people, for NGOs to go into countries and finance overthrows of government like we're routinely doing now too. So I think it's really, really bad, but it has allowed the empire, the American empire, to grow very dramatically. I know I had one guest on my show that suggested that it was a good thing that we went off the gold standard because it allowed us to outspend the Soviet Union. That idea I don't buy, but that was the notion that because we could expand our military-industrial complex so significantly. But what I think it has also done is made us an awful lot of enemies around the world.
Yeah, that's a good point. In terms of the global economy right now, do you think we're setting up for a stock market crash in the next 6 to 12 months?
I think we would have had a stock market crash almost certainly if it weren't for the president's working group or that I mentioned a little while ago that was established during Greenspan's tenure. I have no doubt in my mind that they are doing everything they can, whether it's jawboning or whether it's pushing money into the economy or buying stocks outright. That the U.S. government or the central bankers, the central bank, and the policymakers are absolutely petrified at the notion of a stock market crash. So I think after the Brexit here, we've seen a bounce back. I believe that it's certainly very possible, if not likely, that that is a direct result of massive buying by some very massive trades that go into the market. But or if not that, at least it's about jawboning or talking about the Fed turns dovish right away after Brexit. And so right away, oh, good, we're not going to have to worry about higher interest rates competing with stocks anymore. But Jason, what I think is really interesting to note is that it really seems strange that the stocks are going up. This is one of the reasons I think that the government or the policymakers are behind this move higher in equities. The fact that the bond market is that the T-bonds are making new highs. We're seeing new highs in T-bonds, and we're seeing money go into gold. We're seeing gold be extremely strong here at the same time the equity markets are going up. So somebody around the world are not buying the stock market rise, and they're putting their money into risk-off trades like gold and T-bonds. David Stockman suggested, I didn't get a chance to read his article. I just glanced through the first paragraph or so, that it has to be that they're playing games with the equity market. Well, how can stocks continue to go up if earnings are continuing to go sideways or decline? And the answer is they can go up as long as there's money going in to buy it. And I mean, how many times I just think, people that have tried to short this stock market in the U.S. especially have really lost their shirts. And, I just think it's probably, I pay a lot of attention to an analyst that I have on my radio show almost every day, every week, because my show is a weekly show every Tuesday, Michael Oliver. And he's just been absolutely spot on. He's absolutely convinced that the equity market is going nowhere. In fact, if you look at the S&P, it has actually gone nowhere over the last couple of years. And look at the spread between gold and stocks. So, yeah, I think the whole the global equity markets are in big trouble. But ours is the one that's held up the best. Um, I don't cheer for it because I'm just really worried about what happens when the wheels fall off this wagon. But the debt, the insolvency of banks, the insolvency of companies, what might result from that? I mean, gold is doing well now, but I'm not necessarily happy about that because I think what it's doing is the temperature is rising. It's telling us there's some infection in the global economy, and when that temperature rises further and further, we can experience all manner of chaos. If only we could go back to some sort of a free market economy and allow capital to be price allocated, but we don't. We haven't, and so there's going to be one heck of an adjustment ultimately.
Yeah, I think things will get worse and there will be more intervention before we have more free markets. To add to some of your other points, though, I think there's a number of these groups, whether the working group, I think there's a couple of them. There's also the Exchange Stabilization Fund at
Hmm.
the US Treasury. We've seen Zero Hedge articles talk about how the ECB now has a trading department. We know that the Federal Reserve has a trading department. I think the US Treasury either has the Exchange Stabilization Fund or maybe an additional one.
Hmm.
Pippa Malmgren was on one of the groups, and she says it's a bunch of academics, but that don't actually do trades. But there's probably a couple other of these groups
Hmm.
that actually do. My sources, I think I was telling you about this when we met in Toronto in 2014. I heard about currency swaps going into the system then to keep things from
Right.
collapsing. I heard there was trillions in additional currency swaps, and we know from the Ron Paul one-time partial audit of the Federal Reserve that there was over 19 trillion just in 2008.
Hmm.
Jim Rickards has come out recently. I think he's estimating that 30 trillion in liquidity globally, mostly by the Federal Reserve, has been put into the system to keep all these asset prices up. I think though we're getting to that crack up boom phase where the real economy crumbles and the asset markets keep defying logic and going higher. I think these asset markets, Jay, are pricing in devalued currencies
No,
now.
I don't doubt that, and I think it's very interesting what Alan Greenspan said again on this interview last week with Tom Keene. He's becoming very concerned about inflation now because he's seeing. First he talked about M2 is growing at about a 7 or 8% clip over the last several months, and he noted the correlation between M2 and rising prices. And then he just mentioned that, in historical times like these, the ultimate outcome is inflation. And I think it was Tom Keene that said, well, yes, but we don't see any of that now. And he said, well, history is replete with examples of when you had virtually no inflation and then all of a sudden a hockey stick. And, it certainly happened. Now, the crack up boom situation where prices go absolutely nuts and but then they cannot be sustained and you have an implosion because what I see is, if I don't know if you're familiar with John Exter's inverted pyramid
Yes.
concept, but the last thing that, I mean, you have the value coming down from more speculative items at the top of the pyramid to the more liquid, more essential items at the bottom of the pyramid. And he had it next to the bottom was uh, actually at the very bottom was U.S. Treasuries, and then he had outside of that, the way it's supposed to really be drawn, though most people don't draw it that way, he has a gold coin, and perched on that gold coin is this inverted pyramid. The reason the gold is outside is because he says when the system completely breaks down, when people lose confidence in the treasuries, then they go to gold, and then the paper money game is over. And I'm thinking, Michael Oliver, who does this wonderful work, has been suggesting recently, a couple of weeks ago, in fact, before this major move in the T bonds, that we were coming very close to a blow off in T bonds that he thought might last for 2 or 3 months, and then it's going to be a reversal. So at some point in time, when people wake up and they say, "Wait a minute, we don't want to have dollars anymore. We don't want T bonds. We want something that's real." And when the confidence is lost in the system and the dollar, this is John Williams' thesis all along, and I really want to get him back on my show again soon. His thesis always was that we're going to have a hyperinflation ultimately when people lose faith in the ultimate currency, the world's major reserve currency, the dollar. And it's hard for Americans to get their head around that because it's been so strong, and we have this military that enforces it. It beats the hell out of countries and dictators that don't want to use the dollar for they're in the oil trade and elsewhere. But at some point in time, there's competitive forces now. I think people should really pay attention to what's going on in the New Silk Road, or there's a different definition for it now. But I talked to William Engdahl on my show, a historian, and also Jim Rogers talked about it recently when I had him on my show. The the competition, Russia, China, and India and other countries around there are just sick and tired of the United States basically printing these dollars and using them to steal from them. And what's going to happen, and what is happening, is they're setting up their own infrastructure, their own trade infrastructure, their own railway system, and they have imported huge amounts of gold. I mean, I can't believe that all the gold the Fed claims we have and the Treasury claims we actually have. It just doesn't make sense. The numbers don't add up. But Russia being the fifth largest gold producer, or fourth, China the largest, and the imports that are going through Switzerland to China are unbelievable. And of course, India has always been a lover of gold, and I think geopolitically sit on the fence. But there's that whole geopolitical stuff that we don't ever hear anything about in our propaganda here in this country. I think people should pay attention and realize that there is outside competition. Maybe one of the reasons we're putting troops on the border of Russia, maybe one of the reasons we don't allow the Chinese to control their own sea lanes, is because we're worried, and we have to try to keep the dollar. Uh, we have to try to keep the dollar as a functioning currency, as the world's reserve currency, and part of that is geopolitical. I mean, when Nixon took us off the gold standard in 1971, he shortly thereafter, it was Kissinger then that went off to Saudi Arabia and arranged the petrodollar. And that has really been what has put a bid under the dollar, is the fact that countries were forced to use the dollar for the oil trade and for other trades as well. So, I think ultimately the dollar is the question. How much longer does it survive? One part of me wants it to survive a long time, because I don't want to see the sheer hell that results when it doesn't.
Yeah, and gold's insurance to protect against, a reset of the financial system or hyperinflation. One thing I would add, though, about hyperinflation is that a world reserve currency, to my knowledge, has never actually had a hyperinflation. I think they've only had really bad stagflation before, not full-on hyperinflation from a world reserve currency in terms of financial history with other past empires.
Yeah, I think you're right about that, and so therefore I think the only way that we get that is if the dollar ceases to be the world's reserve currency. I mean, obviously, other currencies in the past, didn't. Well, first of all, this is the first time I think we've ever had a situation where all the countries in the world were off the gold standard, where there wasn't any kind of gold backing or metal backing of all currencies around the world. So in a way, it's sort of uncharted waters. But I agree with you. The senior currency tends to get stronger and stronger, but there has to be a limit to that. And so what happens now, whenever there's problems around the world, the treasuries get stronger. But what happens, Jason, when the treasuries go negative, and it's really these negative interest rates are throwing everything out of whack now. And so the functioning part of the economy, I mean, you play all kinds of games you want with numbers and computers and stuff, but when you have negative interest rates and banks can't make any more money because of the yield curve, there's no spread between short term, long term. Things are going to break down. And then, of course, what I fear is more tyranny, more government control of everything. And we lose our freedom and our liberties. That's the main thing that I'm concerned about.
Yeah, I'm also concerned about that as well. I want to transition now to the gold industry, since you do cover that extensively and you actually visit the properties. In your opinion, since 2011, has the gold mining industry done a good job cutting costs?
Well, I think since 2011, they've been forced to. The majors have certainly cut back, but during the splurge, and I think the gold mining industry is not exempt from the problems from easy money as well. And so lots of money sloshed around. The gold price was going up, and lots of capital flowed into gold miners, and they got a little bit reckless. And some of these majors went out and paid way too much for properties that they bought from the juniors. Subsequently, they've cut their costs back. I think Newmont has done a really good job, more than Goldcorp, for example. So yeah, I think out of necessity they have. But these guys get extremely big. The large companies get very big, and they get very desensitized towards towards the markets, and they don't have a long-term vision. So they're not looking out at at the potential for finding new deposits, and so that is being left to the juniors. Frankly am much more bullish right now on the junior miners, the exploration companies that are finding things. And obviously, in a down market, the producers that have cash flow and can survive are better than the juniors. I mean, we saw companies lose 90%, 95%, and some of them are bouncing back and have great prospects now. So, Jason, I haven't found many times in my life, and I've been at this a long time, that I am as optimistic as I am right now about the junior gold mining sector.
Are we at a high enough gold price, Jay, in different currencies where there's going to be a good amount of gold mines built in the next few years, or do we need the gold price to go considerably higher before there's enough capital raised to start building mines?
The gold price in other currencies outside of the dollar, because the dollar has been uh, relatively strong compared to other currencies, the gold price has been very good, and it has really led to some great profits in Canada and Australia and places like that. Um, I think where we're at now, it's certainly bringing capital into the sector. We're definitely seeing people who didn't want to know anything about gold mining companies starting to buy, and so we're seeing new money coming to the sector. I think you're going to see a major increase in earnings of companies, especially the better ones. And no, I think it's of course it's all relative. If oil prices are very low now, a lot of the input prices, that the costs are lower now, and of course you have a lot of miners too. Labor is more available now. Drillers for exploration, you have people that are available. Talent, engineers, geologists that were laid off by some of the base metal miners that haven't really come back yet very much. Copper and other base metals have not responded very well yet, and so no, I think that we're in a good position. Of course, it's all dynamic, and if the oil prices were to spike, for example, that would really hurt. I can remember the first time that gold went over $1,000 and the major mining companies weren't making any money. And the reason was because there was a huge shortage. Energy prices were rising very dramatically, and there was a huge shortage of basic materials that were required. I mean, these big earth-moving machines couldn't get the tires that they needed when they had to replace their tires on these huge earth-moving machines and so forth. So a lot of downtime and all that. No, I think we're setting up for a spectacular move towards higher profits and massive profits. But I think the companies that are going to do extremely well are those companies that are building up multi-million ounce resources that can really they're going to be purchased by the majors. I mean, here's the point: the majors have not been able to go out and replace the ounces that they're producing. They have to get those ounces from some source, and so there's going to be a premium, I think, once again, that's going to be paid. Probably the majors will be, especially if there's competition for various properties. There's going to be majors will be paying too much again, and then at some point in the future they'll be sorry they did. But that's why I like the junior sector so much.
What are some red flags that you've noticed over the years in some junior explorers or junior mining companies that are about to go into production or already in production that you think people should avoid? Geopolitical management. What are some red flags that are you think are obvious to avoid in terms of companies?
Well, I think geopolitics now more than say 10 years ago is becoming more of an issue. So I like to stick predominantly to North America. Mexico is still okay, though I think it's more dangerous than it used to be. Brazil, for the moment, looks good. Peru looks good. Canada, of course, and the U.S. still the best for the most part. Australia is probably okay at this stage. So yeah, geopolitics certainly. But you know what I like to look at, especially the smaller companies, is who owns the stock. Is the management own the stock? How well is the capital structure managed, and who owns the stock is very important. I like to see management own a lot of it. I like to see them own a lot of it with money that they put into the deal. That's always encouraging because then their interests will be aligned with mine. I like to see companies in the early days that have the right kind of shareholders, not just management, but people who are in the game longer term. And there's one company in particular that has done an extremely good job, and they're on their third run right now, and that's Austrian Resources. It's one of my favorites, and they are a sponsor to my radio show. But Austrian, they have the right combination of technical talent and also the people. That is the banking interest, the interest and the connections in the banking sector so they can raise capital efficiently, but they get the right kind of shareholders that are not hit and run artists, but guys that sort of have confidence in the management, will stay there for the long term. So you don't get a lot of people dumping stock when there's a 5% move in the share price that you get with some of these juniors. If you get closer to it, of course, the major issue is the price of gold, the real price of gold, which I like to look at. And I think it's also important to consider not the nominal price of gold, but how does gold look in relative to a basket of commodities? Again, it has to do with the cost aspects. If your cost inputs are going up faster than your price of gold, then it's not a good thing. But what we do see in a disinflationary, deflationary environment, which I believe we're still in for to a great extent, or let's say a credit deflation that we're still in, that what you generally see is that the real price of gold goes up. That is, gold goes up more than, say, energy cost and materials costs that go into pulling the gold out of the earth and refining it and so forth. So those are some of the things. I think, you always look at management. Is management, do they have the skill sets to do what they're doing? And that's more applicable, I suppose, to the juniors. But when you get to the point where companies have done their pre-feasibility work and they're looking now to finance and fund, what's the share structure look like? Is there support? How robust are the economics, even with lower gold prices? How robust are they? Do they have the lifespan that will allow them to go out and raise capital efficiently? Those are some of the issues.
Yeah, not only is there problems with the larger companies replacing reserves, which they basically ignored for the last 3 years or so, we also have other supply side problems. The CEO of Newmont Mining said that he expects the annual gold supply, mining supply, to drop 7%. And I think a lot of that is because of the gold byproduct that's produced from, these copper miners and iron ore miners.
Right.
The base metal prices has just collapsed. These guys are, cutting back on their lower margin, lower grade ore that's higher cost. They're just cutting back on it. And if the prices in base metals don't rise, we're going to see supply problems for a lot of gold and silver going forward because so much of it is produced as a byproduct.
I don't doubt that that's the case. If you look at your lower grade copper, gold, porphyry projects, for example, where can be a lot of gold off, as a byproduct. But that's true. But I think also, though, that the majors have cut back on exploration to try to to enhance earnings, or at least to reduce the losses. So a case in point, this company I mentioned, Austrian Resources, recently picked up a project from a company that went bust. Homestake Resources was the name of the company. They had a project in British Columbia that Agnico Eagle was spending $18.5 million to earn, I think it was a 60% interest in. Well, Agnico Eagle walked away from it because of their need to cut back on their costs, their exploration costs, and so forth. Well, Austrian picked that up for a song and a prayer. Now, that's why I like the junior sector, because the gold hasn't gone anywhere. It's a viable project. Agnico Eagle saw it as viable enough that they were willing to spend $18 million. They didn't walk away from it because the project wasn't viable. They walked away from it because of fiscal issues and the need to make sure their next quarter or their annual profits didn't fall through the floor. So, that's another issue, is that the big guys just have not continue to explore. And truth be told, the big guys, the majors, the Newmonts and so forth, are generally not as good. They're so bureaucratic and they're not as good. They're not free to think. And you have the geologists generally don't have the power in the major companies that they have in the smaller companies. It's more administrative. It's more, addressing the concerns of Wall Street to make sure that the earnings stay up and so on and so forth in the short term. So those are some of the issues, but I just think, Jason, that we're setting up now for one of the most spectacular bull markets in a long time for the junior sector. And I can just tell you that my portfolio, I would just call it up here now, looking at, this is in my newsletter, First of all, I have a portfolio that includes a short in the equity market and a short on junk bonds, and of course, with those are losers, so they brought my average down. But we're looking at something like a 68% return so far in the portfolio overall. I'm trying to get my numbers here. Okay, so uh, 69% we're up so far this year. That's in a portfolio that has we're short on with SJB. That's the high yield, and we're down 8% there. And we're short on the S&P 500. We're down 5% on that ETF. So, but we have for the juniors, for example, what I call my Progress A3 and A4. Those are companies that are exploring and have developed a deposit. They're up on average 224% so far this year. The companies that are close to production are up 156%, and the producers are up 121%. So that's the average, and of course we have some that are up 8 or 900% so far this year. So I don't think it. And then you might say a lot of people that don't watch this industry very closely might say, well, wait a minute, I think it's too late to get into this. But if you pull up a chart on these companies and go back 5 or 10 years before 2011, and you'll see it's almost a non-movement in terms of their historical prices and market cap. So I think that this is one of the most exciting things, exciting times I can remember. And I started writing my newsletter before you were born, probably in 1981.
Yeah, just a year before I was born. I
Okay.
was born 1982.
Yeah,
Almost.
interesting. So I think there are really some great opportunities out there, and
Uh, how much of your own capital do you actually put into juniors? Because I was overweight juniors 2009, 2010, 2011. One of the mistakes I made is I had too many juniors in 2011. I was taking profits on the way up with First Majestic Silver. I bought at $4, sold it at 30. I did have profits in juniors. I was taking money off the table for 500% gains from 2009, 2011. But when we had dips, I thought there was no way that they could knock the gold price back down and keep kicking the can down the
yeah.
road. What do you think is a decent level that people should have in terms of their total portfolio in juniors?
That really depends on everybody. Everybody's different. I think that I tend to overweight because that's a mistake I've made too, Jason. I didn't get out in time. I didn't see 2011 coming, and I didn't bail in time, and so I lost a lot of money. My, but if you were to ask me now, I have most of what I have, uh, probably 50% of my overall portfolio. And we're talking about other things too, some debt instruments and some um, not much in that regard, but I'm talking real estate and things like that as well. So, I mean, when it comes to equities, I mean, my partner Chen Lin does some very interesting things in biotech, and I buy a few of those things from time to time, but I tend to get in and out of them because they're very speculative and take some profits and then. But I think the problem that I have, and it may be something that us Austrian thinkers have, is that we see the structure and we say this is a losing game and they cannot keep this thing going for another round. And somehow, lo and behold, they managed to do it. And you know, I think that you have to be aware that the game can continue on, and the policymakers who don't believe in free market economics at all will do any kind of totalitarian policy that they think might keep the game going longer, or at least keep their friends from losing their shirts. And the people that really, I think, people that really own and run our country are the ones that are calling the shots. I don't believe, for example, that the president in the United States is really the president. I mean, I don't believe that he has that much control over things. That's my personal belief. I think when you look at the Federal Reserve and the people, the powers, the people that can create the money and have control of that. I mean, if the U.S. government had any control, the Congress would be telling the Fed what to do, not the other way around. And that's clearly not the case. I mean, all these congressmen, they really genuflect to the Federal Reserve chairman, whoever that might be, pretty much. And so it's a, but in any event, Yeah, too much, probably too much. And I mean, certainly anybody outside of the Austrian school would say, Taylor, you have way too much in gold and gold shares. Yeah, I suppose that's right. But where do you go? Do you go to the equity market now that's overpriced and treading water and going nowhere? Do you go to the debt market right now? Do you go to treasuries? Well, I suppose until it breaks down, I guess maybe Jason, if you believe that we are heading towards, the senior currency scenario will stay intact for a lot longer, then I suppose treasuries, even if it yields a tenth of 1% or whatever, that might be one place to park your money. It might be safer than in a bank, no doubt, because the government can print more money to pay you back. But you know, do you buy at all, Jason, the idea that we could see an inflation here, that the dollar could come down, and that we would see that Greenspan could be right in his concerns about inflation?
Well, I think we've had different degrees of stagflation for a very long time, and the government's been lying about it in the CPI. They've been lying about the jobs numbers. The GDP numbers are total BS. They're counting government employees on the payroll increasing, saying that's good for the economy. They're counting consumers, getting up to their eyeballs in debt that they can't even pay back, and they're saying that's good for the economy. It's just totally ridiculous. Keynesian economics is based on ridiculous consumerism. That's one of the parts that screwed up about it. I think everyone's trying to devalue their currency because that's what these guys who were taught at most of the same schools know.
Yeah.
So I think eventually what's going to happen is, we're going to have these central banks are just going to give up, and we're going to have, 1933 FDR type of moment where a lot of these economies are going to say we have to devalue against gold or something
Yeah.
like that.
Mm-hmm.
And then, to drastically reduce the value of the debt.
Mm-hmm.
And then, maybe there's a windfall profits tax on holders of physical gold
Right.
or something like that.
Right.
They're going to change the rules. I live right outside of Washington, D.C., and there's just so many lawyers here, Jay, that
Yeah.
are running things
Yeah.
that have no technical knowledge of any of the government agencies they're running, but they're lawyers.
Yeah.
So they're gonna keep rewriting the laws, tons of different revisions until they think they get it right, and they're just gonna make things worse and worse and worse.
So, Jason, do you? I'm interviewing you now, but I just would like to know. Do you see then possibly you mentioned Roosevelt, 1933. I know Jim Sinclair and I think maybe Rickards and some others have talked about this possibility of revaluing the dollar in terms of gold, or to try to reflate the global, or let's say to get rid of the debt. So we might see something similar to what Roosevelt did. He call in the gold and then reprice it higher later, in which case the gold mining shares they did extremely well in the 30s. Might be an argument for diversifying not only in gold holdings, gold bullion, but also in the shares. What are your thoughts on
Yep.
that? Yeah.
Yep, that's exactly what I've told our paid consulting clients who want my opinion on how I see the world. I have rules of money that I wrote 3 new rules of investing in the new normal. And rule number 1 is that people in power are going to change the rules all the time.
Mm-hmm.
So if you think that you're guaranteed to win by putting most of your money in Bitcoin or putting most of your money in rental properties, locking in a fixed rate mortgage and generating positive cash flow rental properties, or putting all of your physical gold and silver holdings, at your house. I think that's extremely dangerous in this environment because there's so many lawyers and bureaucrats in power that, in an emergency situation in a week, they could totally change all the rules.
Yeah, absolutely.
And totally screw you over.
Absolutely. Absolutely.
Well, Jay, I think I've kept you for a long time. I think I could probably talk to you for another hour or two and not get bored. I really enjoyed this conversation. But please tell our listeners more about your radio show and your newsletter.
Yeah, the radio show is live on Voice America at 3 o'clock Eastern time every week, or you can listen to it via podcast at J Taylor Media, Jay Taylor Media, the following day. My guest next week is Ron Paul, and I will be talking to Michael Oliver, who has just been absolutely spot on as a technical analyst. He uses some tools they're his own proprietary tools. I can't find anybody that's been more spot on than he has been, so I have him on almost every week. And I'll be talking to the CEO of a very interesting gold mining company next week. But the newsletter, if you go to miningstocks.com, you can subscribe to that, as well as my partner Chen Lin, who writes a very excellent newsletter on biotechs and a lot of other different segments that he covers as well, sectors that he covers as well, and that is at miningstocks.com as well.
Excellent. Well, hopefully we can have you back on in the future and you could talk about gold stocks. Our listeners love to hear different newsletter writers' opinions about gold stocks.
Excellent. Well, thank you very much, Jason.